is the premium on your CDS is about 31 basis points at the end of the year. So mark to market, it's probably at the high teens or 20s. So would you consider to unwind this position? Are you allowed to do it? In the annual report, you say no, but probably you can make exactly the contrary trade on it. That means you are buying protection. Is that a philosophy which you stand behind? Could you do that from the ethic point of view when the premium are extremely low, which is at the case that the spreads are, as I said, between 15 and 20 basis points? Can you get a
Charlie, that sounds like it was designed for you. I think he was referring to, we have one position left over from 6 or 7 years ago or thereabouts that involves us selling protection on zero coupon municipal bonds with a nominal value, maturity value, which is, since they're zero coupons, is far off and not present value at all of, I think, $7.7 billion or something like that. And we're just sitting with that position because we like the position. And the gentleman mentions that our CDS is, that's an insurance premium against our debt that people buy. There's a fair amount of activity in it from time to time, and I think that's partially caused by the fact that we neither collateralize that municipal contract that he refers to, but we don't collateralize, with minor exceptions, the equity puts that are still out there. So the counterparties have to buy, I believe this is the case, I think the counterparties have to buy protection on Berkshire's credit through CDSs. Now, the people they buy it from, their credit probably isn't as good as Berkshire, so I mean, I think but it's probably in an internal rule at some of these firms that are on the other side of the contract. And so, but that really doesn't make any difference to us. Back in 2008 and 9, our CDS prices went up to a crazy level. And I even commented here at the annual meeting that I would love to be selling them myself, except I wasn't allowed to. But what goes on in the CDS market really isn't of any particular interest to us. And it's too bad for the other guys. They didn't get collateral from us, and we wouldn't have given it to them. And so they have to buy these things that, like I say, from our standpoint, they're wasting their money, but they probably have internal rules that make them. I think I've addressed your question, but Charlie, do you think I've addressed his question?
Well, the truth of the matter is that we don't pay much attention to trying to get an extra 2 basis points by being gamey on our short-term things, and that credit default position is a weird historical accident, and we don't pay much attention to it either. It'll go away in due course.
Yeah, all of our contracts are just going to expire. Now we do a few operational contracts in our energy company. I mean, there's a couple places where they, for their own reasons, and sometimes because the utility commissions want them to, they do certain things, but it's peanuts. And the positions that I instituted 6 or 7 years ago are basically all in a runoff position, and the first big runoffs will be in 2018, in a couple of years.
We're basically not in that. We don't fool around with our own credit default swaps at all.
No, never. No. But I would have liked to have sold them in 2008. They actually got up. People were paying,
I know, it was
500 basis, about 5% in terms of betting that Berkshire would go broke, which was totally crazy, but I couldn't take advantage of it. I wanted to, though.